Let's talk about two accounts associated with long-term assets: property, plant, and equipment, also known as PP&E, and accumulated depreciation. Property, plant, and equipment, or PP&E, is a normal asset, whereas accumulated depreciation is a contra asset. As such, for PP&E, the beginning balance is on the left-hand side or the debit side. In contrast, for accumulated depreciation, beginning balance is on the right-hand side or the credit side of the T-chart. When we purchase PP&E, we would debit PP&E and credit cash. Hence, the purchase amount goes on to the left or debit side of our PP&E T account. During use, we'll take into consideration of depreciation expense, and we would debit depreciation expense and credit accumulated depreciation. Therefore, the amount that goes into the depreciation expense gets recorded on the right-hand side of our accumulated depreciation contra asset account. When we sell PP&E, we would debit cash, debit accumulated depreciation, and credit PP&E. If there's a loss, we would debit loss on sale of PP&E. If there is a gain, then we would credit a gain on the sale of PP&E. Regardless of whether there is a loss or a gain, these three accounts will always show up: debit cash, debit accumulated depreciation, and credit PP&E. So the sale amount for PP&E, when we credit it, goes onto the right-hand side of our PP&E T account. The associated accumulated depreciation gets debited, so the sale amount gets put on the left-hand side or the debit side of the accumulated depreciation T account. And then we can find the ending balance. Let's work on an example. Bite-Size Q&A has the following account balance for the year ending December 31st, year 3. So on that date, their equipment has a balance of $900,000. The beginning balance was December 31st, year 2, which really is January 1st, year 3. That was $650,000. For accumulated depreciation, the end of the year balance is at $360,000, and the beginning December 31st, year 2 balance is at $306,000, and there was a gain on the sale of equipment of $22,000. During the year, Bite-Size Q&A sold for $88,000 a piece of equipment that originally cost $140,000 and purchased several pieces of equipment. Based on the above information, what is the depreciation expense for year 3, and what is the amount of equipment purchased during year 3? Let's use the information that we have and look at our equipment and accumulated depreciation accounts. Equipment is an asset, so beginning balance is on the left-hand side, and the accumulated depreciation beginning balance is on the right-hand side. In the table, we're given the beginning balance, and those are the December 31st, year 2 balances, because remember, December 31st, year 2 becomes January 1st of year 3. So we can record $650,000 of beginning balance for equipment and $306,000 for accumulated depreciation. We also know the ending balance for equipment that's at $900,000, and for accumulated depreciation, that's $360,000. What else do we know? During the year, Bite-Size Q&A sold for $88,000 a piece of equipment that originally cost $140,000. Let's think about the journal entries that are associated with this. During year 3, Bite-Size Q&A sold for $88,000 a piece of equipment that originally cost $140,000. That means they received $88,000 in cash, so we'll debit cash. And they sold their equipment, so we have to credit PP&E by $140,000. We know we have to debit the accumulated depreciation that's associated with the sale of the equipment, but we don't know how much yet. But we know a clue. We know that the gain on the sale of equipment is $22,000. So if I were to look at this, we have $162,000 on the credit side and $88,000 on the debit side. So that means the accumulated depreciation amount must be $74,000 in order for my total debits to equal to my total credits. We can record $140,000 on the right-hand side of our equipment for the sale and record $74,000 on the left-hand side of accumulated depreciation. We also know that the firm purchased several pieces of equipment, and we know that purchases of equipment increases our equipment account. Now we can use the information given in our equipment T account and make the following calculation. $650,000 plus purchase minus $140,000 must equal to $900,000. So that means the firm must have purchased $390,000 worth of equipment. And we can record that $390,000 in our T account. What else do we need to calculate? The depreciation expense. Well, for our depreciation expense, we have to use our accumulated depreciation contra asset account. We know $306,000 plus the depreciation expense minus the $74,000 of sale must equal to $360,000 of ending balance. So that means the depreciation expense must be $128,000. So using the information that we have found that the depreciation expense for year 3 is $128,000 and the firm purchased $390,000 worth of equipment. And now you know all about the relationship between property, plant, and equipment and accumulated depreciation.